The 30-year Treasury just hit its highest yield since 2007. That looks scary. Here's why it isn't what you think. If this were a repeat of 2008, credit markets would be panicking. Banks refusing to lend to each other. They're not. Credit spreads are calm, sitting below their 5-year average. So rates aren't high because the system is breaking. They're high because of debt. The U.S. has to refinance $9.7 trillion this year alone, a quarter of everything it owes, and buyers are demanding a higher price to take it on. That's a bill coming due, not a crisis. Different disease than 2008, much more fixable. Now here's the case for why rates come down anyway, and it starts with oil. Oil drives inflation more than almost anything else. Oil spiked past $110 a barrel this spring on the Iran war. Inflation followed it up, right on schedule, peaking in May. Since then, oil has dropped roughly 25%, and in June, core inflation cooled for the first time all year. Growth confirmed the same story. Yesterday's GDP print came in soft, 1.5%, well under what was expected. Cooling growth plus falling inflation is the exact setup that forces a central bank to cut rates. We're already deep in that window. Meanwhile, the AI trade looks unstoppable on the surface. Microsoft just posted its biggest quarter ever. Amazon had its fastest cloud growth since 2021. These are real blowout numbers. But look at what's actually happening underneath. They're spending money faster than they can turn it into working data centers. Power equipment now takes over 2 years to deliver. Up to half of the data center capacity planned for this year is projected to slip to 2028 or later. The money's going in. The buildings aren't coming online fast enough to use it. And it's starting to hit the cash. Amazon just posted negative free cash flow for the first time in 3 years. So did Google, its first negative quarter ever. Microsoft and Meta are still positive, but their cash flow is down sharply too. Every one of them is now funding the build-out with debt. Same move Washington is making with that $9.7 trillion. Same disease, one level down the chain. That's the wall. Spending can't keep outrunning cash forever. At some point, the capex has to slow down, whether they want it to or not. And you can already see money starting to question it. Semiconductor stocks ripped 25% in a single session this week. That's not conviction. That's a crowded trade unwinding fast in both directions. Bitcoin barely moved the same day. When the most speculative chip stocks are swinging wildly and Bitcoin just sits there, steady, that's usually the early sign of a rotation. Capital quietly moving from the crowded trade into the next one. Put it together, growth is slowing, inflation is falling. The Fed is getting boxed into cutting. The AI trade is hitting a real supply wall. And rotation is already showing up in the tape. High rates squeeze every market at once. Lending slows, borrowing slows, spending slows, that's just mechanical. When rates finally roll over, all of that pressure releases at once and it looks for a new place to go. Twice this cycle, the first rate cut has been a major catalyst for Bitcoin. In 2019, it ran 85% into the cut. In 2024, it sat flat, then ran 73% after. Bitcoin doesn't creep into a move like that. It sits still while everyone argues about the Fed. Then it goes vertical all at once. Right now, the market is still pricing almost no chance of a cut this year. That's not priced into Bitcoin yet. That's the entire trade. Rebel Dividends is spot hype. Unleveraged, paying a weekly dividend, 120 straight weeks, paid every single week while the market figures this out. Never guaranteed. Hasn't missed. If you've been waiting for the setup before adding or switching to reinvest, this is it. Call Dean, no pressure, at your pace. 505-322-7515.